Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Nam Phan of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is pears on old TV. Pears, P-A-I-R-S, not the fruit. Pears on old TV. All right.
I don't know of any pears if it was the fruit on old TV.
Yeah, that's true. Yeah, I wouldn't know too many of those pears either. So Nam, first of all, give us a little background on Pacific Private Money. What's going on with you guys?
Sure. So background of Pacific Private Money, who are we? So Pacific Private Money, we are an alternative lender on real estate, alternative mortgage lender. So, when you go down to the bank to get money out of your ATM, that bank is probably could make you a home loan. You hear of advertisements on the radio all the time for, the different mortgage companies that will, like as of last year, get you into a home with a loan, as low as 3% interest.
Yeah.
Well, those days are over, but that's not the space that Pacific Private Money operates in. We are alternative lenders, meaning that we are essentially non-bank lenders, non-conventional, non-agency lenders. So our rates tend to be higher, and our clientele comes to us when, bank financing is not an option. And alternative lending used to be called hard money lending. That name has changed somewhat in the industry. We're trying to get away from that because it really isn't hard money anymore. It's alternative for a number of reasons, but and the reasons why people can't get a bank loan isn't because necessarily of derogatory credit. As we talk about here, people oftentimes come to us because they have transactional distress, meaning they're in a situation where a bank either won't do the loan or can't perform on providing a loan, and oftentimes it just comes down to speed and then circumstance. And we'll go into some examples later of what those circumstances are. So we've been operating in this space since 2008, and today, where our business is thriving. Alternative lenders are thriving across the country because we provide a solution that a lot of borrowers, whether they're people borrowing to buy a home to move into, or developers who are borrowing money to build or rehab multifamily homes or build homes from the ground up. The alternative lending space has a pretty big audience of borrowers for different needs. And, we were talking about just before the show started, with the interest rates rising and, the talk of a recession happening, how has our business been? And, talk about this pretty much on every show. At least we've been able to, knock on wood, since I've been here at Pacific Private Money, business is busier than ever. I mean, when I started in 2015, alternative lending was just starting to really take off. And every year we've grown, 20% or more.
Yeah.
And in fact, between 2020 and 2021, we doubled. And we're on pace to double our business this year. And I talk to investors all the time who say, I hear you on the radio and you always talk about how good business is. Is that true, or what's going on with your business?
Hey, if it's on the radio, it has to be true, right?
Yeah, I know. Radio second, internet first.
Yeah, that's right.
Right. And it's just, for business continues to grow for a number of reasons. I mean, one is we constantly are hiring good people, salespeople who are, connected to their marketplace. So that's one thing. The industry in general is doing really well and growing, and not without its bumps and bruises along the way, but for the most part, most of the lenders that we talk to or are networked with are continuing to show success as well. So it's not like us against other alternative lenders.
Yeah.
We're doing better than everyone else. Everyone is actually doing pretty well. And thirdly, we have a diversity of loan products, and so we appeal to a lot of different people with alternative lending needs. And we'll talk a little bit about how we're able to continue to grow in this during this market, and in the next segment. But Pacific Private Money is continuing to grow, and we'll talk about capital on the others later on. But we're constantly growing our capital stack so we can fund loans.
Yeah, because that's a question. It's like, where do you guys get your money from?
Right. So we get our capital to fund loans from individual investors, some from institutional investors, but largely from individual investors who have to meet the accredited investor requirements, and are looking to earn rates anywhere from 6-ish% on up. So it's a thriving business for us. We continue to make loans, and the demand continues to be strong even in this market, and we'll talk a little bit about why that's the case.
Yeah, because even with interest rates, going up, prime rate and everything, I don't think that CD rates or bank money market rates have moved that much, have they?
No. You haven't seen that move much, or if the bank tells you we've increased our rates on the CDs, it's now 1.5% from 0.5%. I mean, that is triple.
Yeah,
but it's all relative.
Yeah. All right. Tell you what, we're going to go to our first commercial break here. The trivia theme is pairs on old TD. Here's first trivia question. What 1960s TV show had the pair of siblings named Pugsley and Wednesday? All right. That's our trivia question. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate, which is worth over $100. So make sure you call right now. What 1960s TV show had the pair of siblings named Pugsley and Wednesday? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back.
Yeah.
Welcome back to The Best of Investing. I'm Edward Brown along with Nam Phan. Our first trivia question was, what 1960s TV show had the pair of siblings named Pugsley and Wednesday?
Was it The Addams Family?
It was The Addams Family. Yeah, I mean, who'd name their kid Pugsley? Man, that's a tough one to go through life. That's like the the joke where guy says, yeah, my son was really happy that I named him Luke from the Star Wars character, but my daughter Chewbacca, no, she wasn't too happy with that one.
That's funny. Wednesday is not a bad name, but
no, that's a cute name. Yeah, she's a cute little girl too. Okay, so Nam, where do you get your money from? Well, actually, let me. You know what? Before I do that, let me go into the email question we received. Why are private lending rates so much higher than bank rates?
Yeah, so private lending rates, alternative lending rates are higher for a number of reasons, but typically, how much higher are they than banks, right? Typically, they're about 4 points higher. So when rates, conventional rates for a mortgage were as low as 3% last year, then the lowest private money rates you could find out there was about 7.
Yeah.
But more often it was like 7.5 or 8. So it's about 4 to 5 points higher.
Okay. And
the reason why is it's what the market will bear. You've got scenarios where they're really, where a borrower can't get bank financing, that low interest rate that they want, or these days it's higher. It's up to 5%, 6% in some cases, and typically they need it fast. They oftentimes don't know they need it until bank financing falls out, and so for an alternative lender, your operational costs have to deal with having to source capital quickly, having incentivized that capital to invest in, real estate-backed mortgages that are non-bank, and then just the costs of not well actually. The other thing too is you're not holding these loans for very long. So alternative lenders are usually plan B. And so typically the funds are needed for a short period of time. So there's not a lot of time for an alternative lender to make money on the interest that's being charged.
Well,
So
also
it's
from the
short-term.
borrower's standpoint, if he's not holding the loan that long, it's really not that painful either.
Yeah. So, so if I was saying, 4% higher or 4 points higher than a conventional rate, today conventional rates are around, 5%.
Okay.
Or higher. So private money rates have gone up to 9.5, 10%, which is what it was 5 years ago. So we're kind of back to what rates were about 5 years ago, and people can be shocked by that in one sense, but that was the norm 5 years ago. But these borrowers, in many cases, in our loans, for instance, they're in our loan for about 4 months. So let's say it's a 10% interest rate, but they're only keeping it for 4 months. In theory, they're really having it for less than, they're really effectively paying about 2.5%.
Yeah.
For that time. So the private money lender really is not earning a lot of interest on that loan for 3 or 4 months, compared to a bank that is holding a mortgage for 30 years, up to 30 years. So they're making their money over that time period. So anyway, I hope that answers that.
Well,
that
yeah. So
question.
then, why would you make loans that would only be in existence for 4 months on average?
Well, you can also, so the other part to that is how do private money lenders make income, generate revenue? We can charge origination fees.
Okay.
So that's anywhere from, let's say, 1.5 to 2 points, or 1.5 to 2% of the loan amount.
Okay.
So that's one thing, and they make other fees too, like you would with a conventional loan. Sometimes they're called jump fees, but
Okay. But the thing is, your the interest rates are higher, and that's got to be because your cost of capital has to be more than what Wells Fargo gets money from the federal government at.
Right. So if we're charging 10%, part of the reason is because our cost of capital could be 9%, or it could be less. Hopefully it's less, so we can make a greater spread. But that's where investors come into play. Our investors. If our cost of capital is 9%, that means somebody's making 9%. And in the alternative lending space, oftentimes it's individual high net worth investors that are local, meaning local to the local private money lender. And they like investing in real estate debt because it's collateralized by real estate. Most of ours is residential, although we have some commercial.
Yeah, it's not like a credit card that's unsecured debt. It's really secured. And by the way, I forgot to ask you to give out your information when we went to the last break, because sometimes what happens is people listening to the radio, they say, well, that sounds kind of interesting. I'd like to get more information. Who is this guy and how do I get a hold of him?
Yeah. So our company is Pacific Private Money, and our website is www.pacificprivatemoney.com. There's a lot of information on the site about the various funds we have, and including the rates of return. But if you want to call us as well and schedule an appointment to talk or meet us in person, you call us at 415-883-2150. That number again is 415-883-2150. And happy to talk. You'll end up talking to myself or a few others who work with investors, who are interested in investing in our various funds. So it's it's something we used to do more often in terms of investor outreach. We would have events to let people know about the different funds we have or why private money exists. But I don't know. I thought we were going to open it up again, but it seems like everyone's getting COVID now, and it's still it feels like April 2020 right now to me, because
it's funny, I actually have a couple of friends who are sick, but they say it's not COVID. It's some other kind of like cold or flu bug.
Yeah. Quite
So,
a few people in our office have tested positive in the last several weeks, not necessarily because of coming to the office and catching it from somebody else, but it's
yeah.
been just everyone, or not everyone, but a lot more people are getting it today.
Now, they must
Um,
have some kind of symptoms to make them even get tested, right?
yeah,
Like
yeah,
someone's not
yeah,
feeling well and said, "Yeah, I think I'll test just in case."
yeah,
Yeah.
exactly. So
Okay.
hopefully we get past this, but
Yeah. Well,
looking
you know
forward to
what?
that.
Otherwise, we'll have to just you'll just have to do the Zoom webinars again. You know,
Yeah, yeah, we're due for that.
yeah, because you get enough people who are interested in this. Tell you what, we're going to cut to our second commercial break here. Here's the trivia question: what 1970s TV show had a pair of siblings named Keith and Danny? Now, there was actually 5 kids in the family, but those are the 2 main boys, Keith and Danny. All right, that's our trivia question. Call 888-912-1190. First caller with the correct answer wins that tanning certificate worth over $100. Again, I'll ask it one more time. What 1970s TV show had the pair of siblings named Keith and Danny? All right, stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown here along with Nam Phan of Pacific Private Money. Second trivia question: what 1970s TV show had the pair of siblings named Keith and Danny?
The Partridge Family?
Very good. You're 2 for 2.
Yay.
All
All
right.
right. Man, those
That kind
were
of
some
shows
wholesome shows,
it was.
weren't
I
they?
know. I was part of
You
the
know,
Friday night lineup. Yeah.
I know, and not to like sidetrack the show, but you know, so much of what's on television these days, whether it's just regular TV, call it regular TV, or Netflix or otherwise, not a whole lot of wholesome
No.
there anymore, where values are, you know,
Yeah.
are the sort of the theme.
Yeah, but you know what's funny though, but there's also a couple of things from the old TV that they don't do anymore, like smoking. They don't have
Yeah.
smoking on. And in fact, there was an old movie from I think the silent era where it actually showed some people snorting cocaine. Yeah, because they were talking about how it just wasn't taboo back then or something.
Well, I think they purported it as having health benefits,
Something like
right,
that.
back then.
Yeah. But well, the same thing with
But
smoking. Smoking was good for your lungs, apparently.
oh yeah, and all of the
Yeah,
yeah,
yeah.
I remember some fifties ads that are so misogynistic too. It's
Oh
just
yeah,
weird.
yeah, yeah. That's right. Well, it's like, I have this one that says I run things around my house. I run the vacuum
Yeah,
cleaner, the dishwasher, the washing machine. All
yeah,
right.
that's
So,
funny.
Nam, you have an article you want to share.
Yeah, so you know, today's the media is always so you know, polarizing.
Yeah.
Um, so there's so much drama in the media. But you know, one of the things that stands out in real estate, that you know, in addition to the you know, housing market that we're in, or that we were in up until recently, that's starting to cool off a bit, is you know, the lack of inventory in
Yeah.
the marketplace as a driver. And you know, there's several articles that I'll cite here. This one's from Fortune, and I'm reading this one. I'm bringing this one up because of, you know, one of the elements that's reducing the amount of housing stock, and that's that the investors, including Wall Street, this is the article title. Investors, including Wall Street, helped to drive up home prices during the pandemic housing boom. Here's the proof. And essentially, I'm not going to cite it verbatim, but they point to the fact that that institutional investors are acquiring homes at a, you know, and essentially taking that inventory off the market, because what they're doing is they're buying homes and turning them into institutional rentals. So
Yeah.
the first quarter of 2022, investors made up a record 28% of single-family home sales, according to a published report last week by the Harvard Joint Center for Housing. That's up from 19% the first quarter of 2021, and it's also far above the 16% that investors made up of single-family home sales between 2017 and 2019. Now, those investors could be mom and pop, could be large institutions, but essentially, investors buying homes to, some of them are flipping them and selling them to other home buyers, and some of them are holding on to them and creating rental inventory for themselves in the portfolio. So every home that's bought up by that type of investor is one home less that somebody who wants to buy it to live in and to be the homeowner, that availability is gone. And again, this is a article from Fortune. And then at the same time for the housing boom, the pandemic, created a situation where people were wanting to work remote, right? We all know that. We've talked about that for the last several years. But at the same time, it also coincided with the 5-year window between 2019 and 2023, when millennials born during the generation's 5 largest birth years, which is 1989 to 1993, would hit the peak first-time home buying age of 30. So that elevated demand simply overwhelmed the supply side. So housing inventory, which was already trending downward before the pandemic struck, fell to a 40-year low during the boom.
And the thing is, a lot of those kids are sort of out of the realm of the crash, the Great Recession. So they were kind of younger, so they sort of got over it. My son's a good example of that. I mean, he just bought a house last month. Same sort of thing, right in that age group.
Yeah. And so you have a millennial population that, hit that peak first home buying. You have institutional investors acquiring properties at the highest rate kind of ever. And you've got a low interest rate environment that's created so many opportunities for people to refi, not necessarily move, but refi, but also for people to go out and buy. And
also you don't have the credit bubble like we had. There was more of a credit bubble back in 2007 and 8, where people didn't really have to prove that they could afford to buy something, and they were able to buy it. And you can't really do that as much now, so they're getting more quality buyers.
Yeah, and thank goodness you can't. Otherwise, there might be a really ugly side to this boom that we've seen. That we saw in 2008, and I think banks are underwriting, and their government regulations are requiring more qualified borrowers to be able to get a loan, or more qualifications for borrowers to be able to get a loan. But you've got all of these other factors that created this housing boom, and for our business at Pacific Private Money, we do follow and say, okay, is this what's going to happen now that rates have gone up? How is that going to impact demand? But you also have millennials, which was the second largest, population group in the U.S. More and more people are hitting every day that window, that 5-year, that window of being a first-time home buyer. Hitting 30 years. You have an aging boomer population that's downsizing still, and then you have an undersupply of housing. So interest rates aside, there are so many factors that are still in play that make home ownership or buying a home still a very kind of vibrant market. It's been dampened by the higher interest rates, and I can tell you I'm not bummed about that, just because it wasn't sustainable. And that money coming out at the interest rates, hopefully a lot of people took advantage of it to get a low interest rate or refi into a low rate. But there's a lot of free money out there. And now it's coming back to haunt us. And we've got to go through this pain, I think. But the question is how long that pain will last, and nobody knows the answer to that.
Gotcha. Okay, I'll tell you what, we're going to go to our third trivia question. And when we come back, I want to hear some deals of the week. All right, what 1970s TV show had a pair of roommates, Felix and Oscar? Call 888-912-1190. First caller with the correct answer wins that tanning certificate worth over $100. Again, what 1970s TV show had a pair of roommates, Felix and Oscar? Stay with us. The Best of Investing will be right back. Don't touch that dial. Welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with Nam Phan of Pacific Private Money. Third trivia question, what 1970s TV show had the pair of roommates, Felix and Oscar?
It was The Odd Couple.
The Odd Couple. Wow, Nam, that was the first time you ever won 3 for 3.
Oh, come on. I've won 3 for 3 before.
Have you really? Okay, I'm impressed.
Maybe
yes,
one.
But that was always like chemistry questions or something, astrophysics that you usually won.
Yeah, right.
Yeah.
So what were the names of the actors? Do you remember?
Oh yeah, Jack Klugman and Tony Randall. And
So what
originally
other
it was
show?
Walter Matthau and Jack Lemmon.
That's right.
Yeah.
And
Oh,
what
that's
other
good.
show did Jack Klugman do after that?
Quincy MD.
Yeah, I used to love the beginning of that show because I think I was in middle school,
Uh-huh.
and he's like they show him like a close up of him inspecting
Yeah.
something,
Oh yeah.
and throughout the beginning they're panning out,
Oh yeah.
and then it ends with him inspecting like the skin on a woman's leg in a bikini on a boat.
Oh, there you go. I
And you know, as
I
a
loved him
yeah middle school kid, I'm like, oh my gosh, that's so risque. You know, back in
yeah.
the whatever 80s.
It's funny
So
because he was actually in the movie 12 Angry Men with Henry Fonda. If you ever saw that, it's probably one of the
no.
least expensive movies to make because it just took place in a jury room. The whole thing
Oh
practically.
really?
Yeah, he was in that. I saw the movie. I can't remember when, but it was an old movie from like the late 40s, early 50s or something like that, or maybe
Okay.
1960. And I look, hey, that's Jack Klugman, but he was so funny. And remember the policeman, was it Al? No, because he played Al Molinari, ended up playing Al Murray. He played Murray the cop, and he was on Happy Days. He took over
Oh,
for Pat Morita when it was Arnold's.
okay.
Yeah, so that was, I tell you, I watched too much TV,
Yeah,
unfortunately.
same here.
I could name all
Same.
108 episodes of Gilligan's Island, so that kind of tells
I'm
you
sure.
what my priorities were. Like I said, 6 years of high school, right? Okay, so now could you give us an example of a typical loan that someone is going to probably go to the bank first, get turned down for whatever reason, could be mostly speed. It's like,
Yeah.
I know I've heard situations where the banker says, this is a fantastic loan. Of course we would love to do this loan. When do you need it by? Well, I need it in 20 days. Oh no, we need at least 45 days to do this loan. And so they can't do it. So give us an example of kind of loans you've been funding.
So, there's quite a few that we always talk about and use as deals of the week, and that continues to kind of be half our business, our bread and butter, and that's a scenario where you have somebody who has their home on the market, and still in this market, I'd say homes still sell relatively quickly, but while it's listed, they found the home that they want to buy, and so for a number of reasons. It's hard to sell your home first and then buy, or sell your home at the same time you're buying and have those two transactions close simultaneously.
That's tough.
It's a real pain in the neck. And up until about 5 years ago, that was just a kind of a fact of life. And that's why home buying and moving was so stressful for a lot of people, because it's a huge life event, whether you're buying or selling, and usually it's both at the same time, but compounded by the fact that it has to happen in this really short window of time.
Yeah. And you
So
can't
start
have
up the line.
well, in the 80s, you had a contingency sales. Yeah, I'm going to buy your place, but I'm only going to buy this if my place sells. And it's like,
well, yeah, and that was still the norm, but today, so many people are able to make cash offers. So those folks who have a home to sell, there's no guarantee, although there was a high likelihood that you'd be able to sell it in this market, but the timing of trying to get the proceeds from that sale so you can put towards buying your next home, and writing an offer and saying, hey, who wants to take the risk of saying there's no sale contingency on my home?
Yeah.
Stuff happens because there's a borrower who's buying the home you're selling, and what happens if they have a sale contingency on their home or whatever. So a bridge loan, which is one of our primary loan products, is there to help solve that problem, and essentially it allows the home buyer who has a home to sell to not have to worry about selling that home first. They can use a bridge loan specifically to buy their next home and close that transaction, and then they have time to be able to sell their current home, their what we call the departing residence, with a little bit more, well, with more time and less stress than having to do it at the same time as they purchase. So the bridge loan is one that we fund one or two or more of these every week, where somebody is trying to make an offer essentially to compete against all cash, or they just found the home that they wanted, and they now don't want to worry about selling their current home. Also, sometimes people just want the time to fix up the property that they're moving into, or fix up the property that they're selling.
Because I get the highest price for it.
Yeah, get the highest price. Other examples.
Yeah, let me give you an example of one that actually this loan just got paid off. It was an architect who the loan actually came from a mortgage broker who wanted to do a regular conventional loan. The problem was the architect was still in the process of remodeling the new house he wanted to move into. So he still had his old house, but this one was like he kind of ran out of money to finish off the remodel of the new house that he wanted to move into. And so the mortgage broker said, Edward, can you help him out? Because I can't lend him in the condition it's in because of potential mechanic liens. And, it's a built house. It's just getting remodeled, but he still needs, a few $100,000. And so what we did was we were able to get the contractor to sign off, basically saying, yeah, I have been paid everything up to date. So that got rid of all the mechanic lien issues. And then we budgeted out how much he would need for finishing off the remodel. And sure enough, he finished it off in time, and then just got taken out by a regular conventional loan. So that's a typical one. The guy had high 780 FICO score or something, made really good income, but he just happened to be short a little bit of extra money to finish off the remodel.
So that's a great example. And we also have ones where it's a reverse exchange. It's somebody who, who's found the home or property they want to exchange into. And this is not just residential, but it's a reverse exchange where they found the home that they want to, or property that they want to exchange into before they've sold the property that they are currently holding on to. So reverse exchanges are ones. There's probate situations or estate situations where the siblings acquired a property from their parents, and one sibling wants to buy out the others.
Great. So, all right. Why don't you give out your information one more time, and then we're going to come back with some thoughts of the day and some closing comments.
Sure. Our phone number is 415-883-2150. And our email address, our website is www.pacificprivatemoney.com.
All right, stay with us. The Best Investor will be right back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Nam Phan of Pacific Private Money. So, Nam, if people are listening to the show and they say, well, that sounds like pretty conservative investment, because nothing's risk-free, but it's conservative, and I would like more information about potentially investing with your company. What do they do? You have a fund? Do you have funds to invest in?
Sure. Yeah, we have several funds, and they pay anywhere, as I mentioned earlier, from around 6% all the way up to over 10%, depending on the different funds. So if you want to, and I'll just name them off really quickly. There's the Pacific Private Money Fund, there's the Pacific Freedom Fund, and the North Star Capital Fund. Those are the three primary funds we operate. And they all have different needs and uses. The real estate we lend on varies somewhat between them, but ultimately, they all have been. Now we have track record of several years for each one, with the Pacific Private Money Fund being the longest running. Anyway, to learn more, you can give us a call, 415-883-2150, or you can go to our website, www.pacificprivatemoney.com, or you can actually email us at invest@pacificprivatemoney.com. And all three of those are, ways to connect with myself or others in the company who can, provide some more information, much more detailed than what we covered during the show about the types of real estate. What are some of the risks of investing in a fund? What are the pros and cons? And, are there fees? All of those things. So I can tell you that all of them require that an investor be accredited, which means that they have $1 million net worth, exclusive of their primary residence, or they can qualify as accredited a couple of other ways. One is that their income as an individual, their AGI, is they can show on their tax returns for the last 2 years was at least $200,000 per year, or $300,000 as a household or couple. The other way too is depending on their profession. So some professions are deemed, or certifications are deemed to qualify that person as accredited. So for instance, like a financial advisor should be considered an accredited investor. If they're not, I don't know. That's
you wonder why their net worth isn't as high. Yeah, maybe they're just starting out.
Yeah, education. So I think you'll see that definition of accredited investor start to expand to include sort of some common sense, reasons why somebody would be considered accredited.
Sure. But right now, like I believe a CPA and an attorney, because they're considered, they have enough schooling for sophisticated.
Yeah, I mean, if you're a 21-year-old kid and you inherit, $5 million, you meet the net worth requirement, but are you really truly accredited in terms of, having the experience to make sound decisions like that?
Yeah, that's a good point. Yeah, so when you when the audience emails invest@pacificprivatemoney.com or calls your 415-883-2150, they can find out minimum investments as well as how long they have to hold the fund.
Yeah.
If there's any lockup period and that sort of thing. So contact Nam at 415-883-2150. Ask for him. He'll direct you in the right direction there. All right. Are you ready for our thoughts for the day? All right.
Yes, sir.
Stay away from negative people. They have a problem for every solution. Albert Einstein said that. I thought that was pretty good. And why did the photo go to jail?
Why is that, sir?
For indecent exposure. We got a laugh out of you. There's a winner. That's all for today, folks. All right. Audience, stay tuned next week for the best of investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.